Let's talk about the Canadian economy. Not the headlines, not the slogans, the real structural weaknesses that could push this country into a recession within the next year. And according to the Bank of Canada, the IMF, and the OECD, there are three big ones. First, household debt and housing. Canadians now owe about $1.75 for every dollar of disposable income, according to Statistics Canada and the Bank of Canada's 2025 Financial Stability Report. That's one of the highest debt ratios in the developed world, worse than the US, the UK, or Japan. Even though interest rates stopped rising, the pain hasn't. Mortgage renewals in 2025 are hitting at rates 2 to 3 times higher than before the pandemic. The CMHC warns that more than half of new borrowers are stretched to their maximum debt service limits, and RBC Economics estimates that housing costs now consume over 60% of a typical household's income in Toronto or Vancouver. So what happens if home prices fall 15 or 20%? Consumer spending collapses, defaults climb, banks tighten credit. That's how recessions start in Canada, quietly through the mortgage market. Second, Canada's dependence on global trade and the US economy. Nearly 75% of Canada's exports go to the United States. That's energy, autos, lumber, and raw materials. So when the US slows down or raises tariffs like it did in 2018, and again under new trade restrictions in 2025, Canada's economy feels it almost instantly. The OECD's 2025 outlook warns that higher US tariffs and global trade friction could shave up to 1 full percentage point off Canadian GDP growth. The IMF also flags Canada's high external vulnerability, meaning if global demand slips, we don't have much insulation. Put simply, every time Washington sneezes, Ottawa reaches for the tissues. Third, weak business investment and limited fiscal room. Corporate investment in Canada has been sluggish since 2015. The OECD and Bank of Canada both highlight productivity as a critical weakness. Per worker output has barely grown in a decade, and business R&D spending remains half the OECD average. Meanwhile, provinces are walking a fiscal tightrope. Ontario and British Columbia rely heavily on land transfer and property taxes. Alberta and Saskatchewan depend on oil royalties. If housing slows or resource prices dip, those revenues vanish, right when the economy needs support. That's what economists call a fiscal amplifier. The downturn feeds on itself. Now, there is some good news. Inflation has cooled, down from nearly 8% 2 years ago. Markets expect the Bank of Canada to start cutting rates before the end of 2025. That will relieve some pressure on mortgages and consumer credit. But it doesn't erase the structural risks, it just postpones the pain. Because as the Bank of Canada keeps warning, high household indebtedness remains the #1 vulnerability in the financial system. So, what's the actual probability of a recession in the next 12 months? The IMF's latest World Economic Outlook puts Canada's 2025 growth at 1.6%, and the OECD projects about 1.0%, dangerously close to stall speed. Combine that with our household debt, export exposure, and weak investment base, and you get a roughly 28% chance of a recession by next fall. That's not a certainty, but it's a serious warning light flashing on the dashboard. A sharp US slowdown, a global trade hit, or a housing correction could easily push us over the edge. If none of that happens, and if the Bank of Canada times its rate cuts perfectly, we might just skate through. The bottom line is, there are 3 major hurdles we need to overcome quickly: debt, dependency, stagnation. They don't cause the storm, but they make sure we feel it first. This isn't alarmism, it's arithmetic. And unless Canada tackles those structural cracks, diversifying its economy, investing in productivity, and bringing debt under control, the next global shock won't just slow us down, it'll hit home.
Um.